Today, enter the September Swoon, the DFA daily to the 21st of September 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. In today's show, we look at the action on the markets as the risks of a market adjustment rises right in the so-called September Swoon window. This is one of the busiest trading weeks of the year, and for this very reason, volatility in the stock market, as measured by the Volatility Index, rose to its highest level in 4 months, up 23.55% to 2571 in New York. The Dow Jones Industrial Average dropped over 900 points intraday, but settled down 600. The S&P 500 dropped 1.7%, recording its worst day since May. And while the Federal Reserve has a very important monetary policy announcement on Wednesday in the US, it wasn't the Fed meeting that triggered the decline. After subdued inflation and employment reports, economists did not expect aggressive announcements from the central bank, but instead worries about China and the debt ceiling sent equities and currencies tumbling lower. China's property giant Evergrande is on the brink of a $300 billion default, and investors are worried about contagion as there are significant Western bond funds exposed. September is traditionally a terrible month for stocks, and after focusing on COVID-19 for most of the year, Evergrande is a fresh shock that could trigger major liquidation over the next few weeks. Market corrections that broke down throughout the year tightened instantly, with the sell-off in stocks driving currencies, bond yields, oil and crypto sharply lower. The breadth of risk aversion is, well, frankly astonishing. Evergrande, which reportedly faces at least $83.5 million in interest payments due on Thursday with a 30-day grace period, is raising concerns about a liquidity crisis among all Chinese and Hong Kong property companies as markets quickly turned off access to dollar funding. But in a more macro way, the firm's woes are bringing to the fore China's wide-scale regulatory crackdown across most of its businesses, starting with technology giant Alibaba. China's Evergrande, the world's most indebted real estate company, is set to default when its next debt payments come in on Thursday, according to CBA. The key question for the markets remains, is this another Lehman, or are the risks of broad contagion spreading across the financial markets limited? Evergrande will likely default on its debt this week, said Kim Monday, senior economist and currency strategist for CBA. However, we doubt the government will bail out Evergrande by using public funds. Instead, we believe the most likely scenario is that local governments in Guangdong province will nominate a working group to manage an orderly restructuring, and we expect that restructuring will take years to complete, she said. Evergrande's anticipated default has soured risk sentiment, though, across the world, helping to depress shares in Europe and the US on Monday, and is weighing on bond yields as investors retreat for cover. China's crackdown on property developers without a known endgame is what's sapping liquidity from thinly traded equities like Evergrande bonds, which are held in passive emerging market index exchange-traded funds and separately managed accounts at US, European and Asia money management funds. Some of the firms with significant holdings of Evergrande bonds are Ashmore Group and HSBC Holdings, both out of London, BlackRock, based in New York, and UBS in Zurich. The spillover that's happened to other markets is somewhat notable, Ben Emmons, Managing Director of Global Macro Strategy at New York-based Medley Global Advisors, said. In particular, he said, the global stock sell-off was accompanied by falling iron ore prices because of China's stepped-up restrictions on industrial activity. So on Monday, the S&P 500 suffered its biggest slump since May, amid fears that the debt crisis at Evergrande Group will spark a credit crunch in China's crucial real estate sector, and that will flow on to a potential economic crisis in the world's second largest economy. The S&P fell 1.7% and is down about 5% from its recent highs. The Nasdaq fell 2.1%, and the Dow Jones Industrial Average slipped 1.8%, though that had fallen more than 900 points at the lows of the day, as I mentioned earlier. Failure of the Chinese property giant to make good on its debt payments could force it into bankruptcy, sparking a wider liquidity crisis in real estate. And that's a key component of the nation's economy that added to investor angst about growth, the impact of the Delta variant of the coronavirus, and those ongoing budget negotiations on Capitol Hill. The Evergrande crisis comes at a time when the Chinese consumer economy has slowed due to COVID-19 concerns. This could combine to create growth challenges in China and many commodities, D.A. Davison said in the note. This creates more risk for US equity investors who are already navigating concerns about peak growth of US GDP and corporate earnings, consumer hesitancy caused by the COVID Delta variant, inflation, and congressional budget negotiations. Fears of the potential economic crisis in China, the largest energy consumer, sent oil prices tumbling and triggered a more than 4% drop in energy. Financials, meanwhile, were dragged lower by falling bank stocks amid a slump in US Treasury yields, with Wells Fargo, Citigroup, Fifth Third Bank Corp, and others nursing heavy losses. Tech also participated in the broad-based sell-off as investors appeared to take a breather from the buy-the-dip mentality ahead of the Federal Reserve's two-day meeting starting today. Google parent Alphabet, Apple, Facebook, Amazon and Microsoft all ended mostly lower. But travel stocks sidestepped the market's malaise as airlines were boosted by easing travel restrictions. The US is set to ease travel restrictions for international visitors who are vaccinated against COVID-19 in November, according to what the White House said. Gold futures for December delivery was up just 0.84% to 1,766. Crude oil for delivery in November fell 1.73% to 70.58, while the euro-US dollar was up 0.01% to 1.1726, and the US dollar's future index was up 0.07% to 93.23. In foreign exchange, the Japanese yen and Swiss franc were the best performers, which is what you'd expect to see when stocks fall sharply. The US dollar traded higher against all of the major currencies except for the euro, which was unchanged, the Japanese yen and the Swiss franc. If stocks continue to fall on Tuesday in the US, with the Dow dropping, say, 500 points or more, Fed taper talk on Wednesday pretty much goes out of the window. In many ways, the Evergrande mess is a bigger deal for the financial markets than the FOMC. With China refusing to rescue the property giant, we expect to see further weakness in currencies over the next few days. The US dollar is particularly vulnerable to losses against the yen and franc. US housing starts and permits are also due for release on Tuesday. The housing debacle in China could trigger a more significant reaction to housing weakness in the US. Amidst all of the volatility, there are 4 major central bank monetary policy announcements this week: an election and a long list of important economic data. Canadians head to the polls to decide if they want to keep Prime Minister Justin Trudeau in power. A month ago, the Prime Minister called a snap election, 2 years ahead of schedule. Now the race is tighter than he could have ever imagined. Although leadership changes typically do not have a lasting impact on currencies, if Trudeau loses, the uncertainty will trigger near-term weakness in the Canadian dollar. The Australian dollar also remains in focus, with the RBA minutes due for release today. The central bank decided to proceed with its taper plans at its last meeting, which was a bit of a surprise, but said rate hikes probably won't happen until late 2024, which was later than most economists had anticipated. Although the New Zealand PMI services report showed a significant slowdown in activity, the government's decision to ease restrictions in Auckland helped to prevent steep declines in the currency there. The euro was supported by stronger inflation numbers and safe haven bids. Sterling was one of the biggest losers. The Bank of England meets on Thursday, and with no changes expected, the currency is trading primarily on risk appetite. The Bank of England may be one of the least dovish central banks, but with stocks falling and the Delta variant spreading, it will be reluctant to even talk about raising interest rates. Its furlough programme also ends this month, which could lead to some weakness in the economy. Now, more broadly, Karen Malley in the Financial Review penned an important contextual piece. Evergrande's financial woes are raising fears China's huge house price boom could soon bust, which will deal a hefty blow to economic growth. You just have to look at the stunning collapse in the iron ore price to realise just how nervous investors have become about the outlook for China. Of course, the ostensible reason for the deep slide in the iron ore price is Beijing's move to impose production cuts on the country's steel industry due to environmental concerns, but Beijing is simultaneously trying to take some of the heat out of the country's torrid property market by forcing debt-addicted property developers to deleverage. This, of course, will translate into a slowdown in the country's property construction industry and lower demand for steel. Evergrande, which owes more than $300 billion, is the poster child of Beijing's crackdown on debt-addicted property developers, and horrified investors are coming to the belated realization that Beijing has decided to punish excessive risk-taking by allowing Evergrande's holding company, which owes most of the debt, to collapse. Chinese policymakers will of course be aware of the risks of allowing such a massive corporate collapse, and they'll be anxious to avoid a repeat of the 2008 failure of US investment bank Lehman Brothers, which triggered a meltdown in global financial markets. The Chinese central bank has already taken steps to alleviate liquidity strains, injecting 90 billion yuan, or $19.2 billion into the country's banking system last week. And Beijing will probably encourage the state-owned banks to step up their lending to other sectors of the economy. But it is far from clear Beijing will be able to prevent Evergrande's problems from causing the country's massive housing price bubble to burst. That is because although Beijing clearly appreciates there is some undesirable speculation in the housing market, the scale of this speculation is undoubtedly far greater than policymakers realise. This means the country's housing market and the entire economy is much more vulnerable than Chinese policymakers appreciate. And what's more, Beijing has had little experience in the abrupt changes in market psychology and the devastating consequences of a collapse in confidence, which means it's probably underestimating the contagion effects of the Evergrande collapse. Other debt-laden property developers are already feeling the fallout from Evergrande's problems, so investors and bankers will become wary of lending to the troubled sector. That means that to survive, highly geared property developers will have little choice but to dump apartments and undeveloped land onto the market, putting intense downward pressure on real estate prices. Given average Chinese households typically plough their surplus savings into property, a sharp drop in housing prices could quickly cause consumer confidence to plummet. And the combination of an imploding housing market and a souring of consumer sentiment would deal a heavy blow to the Chinese economy and significantly reduce its appetite for raw materials, particularly iron ore. In fact, in a paper titled Peak China Housing, published in August 2020, Harvard professor Kenneth Rogoff and Yasheng Yang from Beijing's Tsinghua University highlighted how central the real estate and construction sectors are to the Chinese economy, accounting for a staggering 29% of Chinese GDP. Not surprisingly, they argue that a slowdown in the real estate sector would act as a big brake on Chinese activity. Given the severity of many economic indicators, China's decade-long housing boom shows many signs of having hit a potential precarious peak, said Rogoff. We find that a 20% fall in real estate activity could lead to a 5 to 10% GDP fall, and that's without amplification from a banking crisis or accounting for the importance of real estate as collateral, they wrote. The paper also highlighted the similarities between China's housing boom with other housing bubbles. Despite the repeated argument that China is different, we note that it shares striking similarities with other boom episodes in the run-up of housing prices, the scale of the construction sector, the debt accumulation, etc. Indeed, given the severity of many economic indicators, China's decade-long housing boom shows many signs of having hit a potential precarious peak. One striking feature of China's housing boom is the unprecedented surge in house prices. Prices in China's Tier 1 cities have risen more than sixfold since 2002, compared to the increase in Ireland of 100% and Spain of 230% in their respective housing booms. Currently, the home price to income ratio in Beijing, Shanghai, Shenzhen and Guangzhou are comparable to the world's most expensive cities, the paper says. In particular, the price to income ratio in Beijing, Shanghai and Shenzhen exceeded a multiple of 40 compared to 22 in London and 12 in New York. And the paper notes that these multiples could be justifiable on the assumption that China will continue to enjoy very fast income growth indefinitely, but it adds, even aside from the COVID-19 pandemic, China's rapidly aging population, a shrinking technology gap with the West, and normal decreasing returns on investment all suggest that future growth will likely be trending downward. And the paper also points out that the real estate and construction industries are intertwined in China because property developers basically make their profits by managing the construction process and turning raw land into saleable properties. In 2016, real estate and construction industries combined accounted for around 29% of China's GDP, comparable only by pre-crisis Spain and Ireland, it said. Real estate and construction are also crucial for job creation, making up to 20% of urban non-private employment. But there are worrying signs, such as high vacancy rates and the existence of ghost cities, that China could be grappling with an excessive supply of housing. It's sobering to recall that US regulators never expected that housing prices would fall by 36% from peak to trough. Even the very cautious, pragmatic Chinese regulators may not yet be fully anticipating the depth of the possible fall in China's housing prices. The paper notes that because China's local governments are heavily dependent on land sales to earn revenue, and because many companies rely on real estate as collateral for their borrowings, even modestly declining prices could pose a considerable risk. But it adds that a sharp downturn in house sales could place a huge strain on developers' cash flows, forcing many out of business, and in turn, a surge in real estate insolvencies would result in people losing their jobs, or at least part of their income, which would reduce demand for housing. And what's more, a fall in property prices would leave households and corporates with less capacity to borrow, which could reduce credit growth. And the paper warns that because real estate is so closely linked to other sectors of the economy, such as construction and demand for household appliances and furnishings, a reduction in housing activities may contribute to a downward spiral in the economy, leading to further declines in employment, income, consumption and investment. Now, pause there. That was a conversation about China. But to my mind, it could absolutely also be a conversation about the property market here in Australia. We exhibit so many of the same factors as is currently on show in China. But of course, here, as yet, there is no intention to try and slow things down. That, of course, builds greater risk going forward. Anyhow, the markets in Sydney opened lower this morning, and we note that the cryptocurrencies are also down. So we are on the cusp of something. The question is, how big a correction will this be, if a correction at all? Or will the markets just brush it under the carpet once again? But it looks to me as though the September swoon is in fine fettle. And if that is true, then expect more volatility and declines ahead. But I want you to leave today thinking about that report on the Chinese property sector and translating it to Australia, because frankly, we are facing precisely the same question mark ahead. Our property sector is too big, over-leveraged, and at high risk. And the contagion effects of that, if it goes wrong, are considerable. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.